This is shocking. Not only did we have a blockbuster jobs report kicking out over 300,000 new jobs created in March, as is coming out just on Friday, April 5th, but we also, on the Great Report, we've got a piece from Moody's Analytics looking at some of the top leading economic indicators that took place in Q1, giving us a really good indication possibly where this economy is going. We still have mixed signals. So the indicators are saying we should still be in a recession, but we're not. We're going through some mid-air refueling, soft landing, whatever you want to call it. And then, of course, from Apartment List, our friends over there, the March 2024 rent report. We'll look at some real-time apartment fundamentals and metrics. You're going to want to stick around, watch the full episode of The Great Report. Make sure you like and subscribe to the Great Capital YouTube channel to keep getting this awesome commercial real estate and multifamily content. Let's get into it. Welcome back to The Report, joined again by Dr. Matt Bosnagel, Director of Communications and Marketing here at Gray Capital. Matt, lovely day.
Yeah.
Happy Friday. We're on the weekend eve of the eclipse. It's not only going to be crossing through the United States, specifically over the Midwest and Indianapolis. Is this an astrological sign that the Midwest has been heating up? I know we're going to get to that when we talk about the CBRE article later today. About how the Midwest is heating up. Before we get into that and any astrological predictions, any seances.
I was about to say, that's about as good as any at this point.
Yeah, exactly. But I just want to jump into this Moody's piece. Looking at some of the top leading economic indicators to try to figure out where we are in the economy right now. I mean, we've got a lot of seasonal factors, so we're starting to see some growth, which we would expect. I know the theme of the Gray Report newsletter this week, Matt, was all about normalizing and just kind of hoping for normal and seeing some of that. Getting into this piece, what are some of the takeaways? Are we seeing that that normalcy, or are we still seeing, as Jerome Powell was saying in his press conference last week, that while the economy is healing and recovering and inflation is reducing, we're experiencing bumps in the road. Many bumps. It's a bumpy road.
Well, for Powell, when he says bumps, I think of rate cuts. But also I think that it is like strikingly normal, and I think that normal doesn't mean good. It just means that it's not as bad, and I think that. It may not be good or bad, but is it predictable? Because I think the qualitative nature of whatever it is, whichever direction, as long as businesses and people can kind of predict, not that we can predict the future, but we have a higher degree of confidence in the future of what the next 3, 6, 9, 12 months might look like. And I think you hit the nail on the head there. And one thing that really ties together this section, at least, or how I've been thinking of the economy this week, is that it is the result of longer term trends. These aren't just volatile bumps up that happen one month and are erased the next. Whether it comes to job growth, which is actually, it's had 3 consecutive months of increasing jobs numbers, or these leading economic indicators that come from the Conference Board, where it shows multiple quarters of slow improvement. So, but what this Moody's article does is it really uses that idea of maybe return to normalcy, or at least a little bit more predictability, and runs through the commercial real estate markets. So, how is this, how are we doing when it comes to the office market, industrial, retail, and apartments? And it does seem like even for each individual one, outside of office, there is no real emergency here, and striking stability in places in sectors like retail, which is just like rock solid, and industrial maybe softening a little bit, but it's still doing okay. And then they spent some real time talking about apartments and talking about how it's been a real gift for the apartment market that demand has been so high for multifamily.
Yeah, demand has been high, supply has been higher. I've heard that said multiple times recently. And so with supply, as supply normalizes, we should be in a pretty good environment. But Matt, if you'll allow me, I just wanted to just read this just quick piece from this Moody's article related to housing. Household quote. Household formation and renter mobility normalized. They're talking about Q1 2024.
Oh yeah.
As home ownership rates trended down, I mean, less people are owning homes, more people are renting. They continue to go on and say multifamily inventory is getting absorbed at a faster clip. Effective rent declined modestly in the first quarter amid elevated vacancy. Okay. They didn't say this, but it makes sense. The supply, they go on, but the adjustment was only marginal compared to the cumulative growth of 18.3% over the past 4 years. So basically they're saying, guys, this last quarter in 2023, we didn't see a lot of rent growth, but rents have still grown over 18% over the last couple of years,
which is over 4% per year if you're dividing that by 4 even.
Yeah, so well
it's like
above
4
the
good
average.
Years. Yeah. And I also like that logic. You reminded me too, and I had a little bit of an issue with how there does seem to be this strong assumption that high home prices are going to lead to are going to lead to higher apartment demand. So the idea is, it's too expensive to buy a house, I will remain a renter. It is invoked a lot in a lot of expert reports. I haven't seen a study that is isolates the strength and magnitude of that effect. But I just saw it's now a week old, but a post from Matt Vance of CBRE. Who, Matt Vance, if you would like to come to the Gray Report, this is a personal invitation from us at the Gray Report. We would love to have you to explain your work that you've teased last week on LinkedIn. He is doing this exact study that I asked for when we were talking about this earlier. So we would love it. Yeah.
If Matt's coming on a little bit too strong, it's okay. No, it would be a good time.
Yeah, I think so too. And I really do appreciate, whether or not it comes on the show, we're going to cover that report because it is a question I've been asking. I literally was talking to you about this yesterday and saying listen, this logic has been invoked and there hasn't been yes, it may work, but are we talking about a 1 or 2% difference? Are we talking about,
and I think it's on the margins. I think people who really want to buy a house, if they can afford to do it, they're looking to do it. That's the choice that they've made. It's a nuanced situation where, if there was a ton of inventory, I think we would expect that single family home prices would come down, just like if there was much less inventory of apartments, the prices would be coming up.
And
But the reality is, most people, there are a lot of people that are on the margins. That's why I say this is all marginal, and you're right. But on the margins, there are people who just no longer can't afford to buy a home, and they're going to be a renter, and they're going to be a renter longer. Or then the psychology, which I think is maybe even more powerful, of now is not the right time to buy a home because of interest rates where they are. But what you're basically concluding and stating and arguing for is this idea that household formation or house demand for housing
in general,
and household formation in general is a much stronger driver that's going to outweigh any marginal differences between renting and owning.
And
that makes sense. And so they're getting the margins, and they're overweighting maybe to. It would be easy for us to say and it's an point that we might make, but it would be, we would love to be able to say, I guess I'll put it that way, that hey, home prices are too high. Apartments are just going to go on a run just because of that. But that's not the reason. The reason is because there's demand for there's demand for all types of housing. And especially now that how affordable apartments are, it's just going to accelerate that. But there's demand for all kinds of housing driven by household formation and millennials and demographics and the rest. So
I totally agree. So those forces that are affecting all of housing are really the ones that you should watch if you were to watch anyone.
Yeah, I agree. So where would you like to go? This is a big piece, and we also have the LEI, leading economic indicator stuff from the Conference Board. Where do you want to jump to next?
Run through these other sectors that they talk about, like the office sector. Obviously, it's really a depiction of a sector holding on, or what they say, I think it's slowly bleeding. Certainly not dead, but it is still
it's bleeding out.
It is not getting any better than it was, and in a way that so rent growth or vacancy was, what is it,
20% right now? It's close to 20%.
Yeah, and that's even worse than it was before, it seems like. So it's not even the snapshots, snapshots and the trends are not the friend of office. But retail is a little bit different, and it is like I said, strikingly stable. It's just quarter after quarter of fairly stable, steady vacancy numbers, and maybe even a little bit lower recently than they were before, and so that's pretty great. And then rounding this out, we can talk about industrial, where it has a little bit of increasing vacancy, but it's the only sector that hadn't had a quarter of rent loss or of negative rent, whereas retail, office, and apartments still had a little bit more shaky. So I think
they haven't yet. And industrial has been a really an outperformer of all CRE the last couple of years, even more than multifamily in some cases on like a total return standpoint. But I think they're also dealing with some oversupply issues right now. I think that there's a lot of confidence that excess supply is going to be absorbed. Have to be reminded that a year and a half ago, Amazon put a pause on a lot of the real estate projects. They've restarted back up now.
Oh, interesting.
Recently. But I mean, just look at this graph. I mean, they were cranking at 7% rent growth in 2022, and we're down to it's not negative, but it's a fraction of a percent at this point, which was, not too dissimilar to, pre-COVID times, but it's definitely the trend is slowing down for industrial. That is for sure. Whether it's going to go negative, I think that is yet to be seen.
Yeah, and there's talk about the Inflation Reduction Act or whatever, whatever amount of money the government's going to juice into reshoring or onshoring, anything like that.
We're going to talk about that in a little bit.
Yeah, but in terms of just the regular economy, I wanted to note some of this information that I reviewed as part of this article, kind of connected to the Moody's Analytics article, and talking about how do people feel? Do people feel like there's a recession coming? Are there any ways to measure it? And should we really get as excited about these new jobs numbers that showed pretty good news for when it comes to employment? But for this conference board, what I noted is that this is the first time that the leading economic indicator has inched up since, I think what the article said is since February of 2022. That's more than 2 years ago. So it's a long way before we get past all of this, accumulated bad economic value or bad economic baggage, bad vibes of the past, pandemic and recession. But it's trending up now. But still, if you're taking a snapshot of it, we're in the negative zone. We may break through into a more positive outlook, but it's still not perfect. However, this is a trend that is more than a year in the making, and it's not just some, almost 2 years in the making, and it is not some kind of freak thing that is occurring. So I think that there's still an opportunity to.
What's good about that, if we're looking back at this, I mean, the recovery, that snap up. There's not a whole lot of it snaps up and then drops back down to the level. It's usually okay. We've gone through a recession, and I just the terms that we have. The names that we have, recession, depression, correction, none of them accurately apply to the economy for the last 2 years. Someone's going to make a name for it, just like we made up stagflation in the 70s, because it's not exactly stagflation, because we have really good employment, we have wages growing, we have positive economic activity. We need to make up a name, Matt. What's the name? What's the? I'm like,
a lot of people are saying vibe session is but that seems too trendy for me.
Way too trendy for me too. But also, that's all. I feel like that's only talking about a part of all this. It's not encompassing all of the muck and everything else, the soft landing and the inflation and the specifically. And you listen to the Federal Reserve, this phenomenon or the happenstance of the extreme supply chain bottlenecks and this switch of demand from services to goods, and how not only that demand surge but then the supply getting squeezed, causing this recession. And then even though they did tighten monetary policy extremely into restrictive territory, moved faster than they have in decades, unprecedented rate of increasing Fed funds rate, At the same time, we had supply chains normalizing and consumers switching back to services from goods, and becoming much more imbalanced, and the economic healing, as Jerome Powell would say. So it begs the question, how much have the higher interest rates, is that even been the factor that has brought recession in line, not as low as the Fed wants to see it?
Yeah.
How much interest rates really doing? But then you also have to beg the question, well, how high would inflation have gotten without bringing rates to where they need to be?
Yeah.
But even with a really strong jobs report, again, reading between the lines, what Jerome Powell said, we don't need to see recessions back at 2%. And if we're shocked that the unemployment rate is so low, and if that's doing so good, now that allows us to focus on the two mandates are stable employment and stable prices. Low employment, stable prices. And so if employment's good, we can tackle the pricing, but it's going to become a risk more and more of keeping rates so much higher. And so if the employment situation is good, they might decide that they can start shifting back and normalize away from restrictive territory on the Fed funds rate sooner rather than later.
Yeah. I think that I think that so much of this feeling of maybe the economy is doing bad is because it's hard to figure out where the bad is. Like this uncertainty, where's the linchpin?
And that is the vibe session.
Yeah,
if you ask me, I think commercial real estate or multifamily has been in a vibe session, recession, certainly correction. I mean, there's prices have corrected 15 to 30%. So our industry might as well have gone through a recession.
That's more pointable than a lot of other places for sure.
And we don't always we always look at the economy as one large monolith, which it can act as a collective force that way at times. But just the same way you'd say, we talk about national real estate performance and national United States rent growth and United States occupancy. And does that matter? Yeah, it does a little bit, but what does the national average rent growth for the country have anything to do with a specific market and a specific submarket in a neighborhood? That's where the rubber meets the road.
Property that you own or whatever.
Yeah, exactly. Yeah. So it's the same thing with different different segments of the economy. Manufacturing can be in a recession when the rest of the economy isn't. And vice versa. And so in 2021 and 2022, there were industries that were suffering. I mean, think of all the services, the restaurants. There were businesses that were many businesses closed down. While our business, the multifamily business, at first we thought we were going to go through major hurdles with people not being able to pay in COVID, but it ended up being in the most incredible market of our lifetimes, with record rent growth, record occupancy, and record sales prices. So while we were doing that and saying, oh, we're selling all these at great prices and everybody's making money, other industries were, having to, shutter their doors. So, all things go in cycles, and there's a little bit of karma out there. So, no industry, nothing's perfect, nothing's going to be unscathed. Damn. I'll tell you one thing though, Matt.
Yeah.
I mean, for the fact that multifamily can get through a pandemic and whatever we're dealing with right now.
Yeah.
Not that there aren't foreclosures, not that there isn't distress, but by using a little bit of risk mitigation and buying right and not getting too aggressive.
Yeah.
I think there's a lot to show, and really, if multifamily is proving its resilience. Yeah. Again, not resistant. Nothing's recession. Nothing is Teflon completely to economic downturns. And if you run a floating rate loan and as your rates went from 0 to 5.5, well, you can get on the bad side. Too much, you can be on the bad side. There's risk in everything. Going all over the place right now, but it is interesting that the sum total of the way that we're looking different ways, and we'll parse out these indicators on what actually they're looking at here right now.
So,
too.
And I want to use this too as a good segue to this Wall Street Journal article that I've been thinking about all day today. But the components of this leading economic indicators, there's a lot of, there are financial components like the S&P 500 and the interest rate spread and the leading credit index. But there are also other factors like manufacturers' new orders and average weekly hours and building permits. But a large part of this is the average consumer expectation for business conditions, which is sentiment, which is vibes. And you noted this actually. While if you're taking the 6 months average, that's a big negative drag. The most recent numbers for these the sentiment number is quite low, still a little bit negative.
They're almost vibing neutrally.
Yeah.
But the total non-financial
neutrally.
components is positive 0.1.
Vibing neutral would be a really good radio program.
Oh yeah, neutral vibes. Yeah,
All right, sorry.
good. But it's true, and so I mean, and so much of all of this is psychology.
Yeah.
We talk about numbers and rates all day long, but it's how people feel, and because it's humans' decisions. It's human decisions and action is what translates to economic activity and purchases, and then turns into a number on our screen.
Yeah, it's not invalid. So. The feelings aren't invalid, but if you ask the Wall Street Journal, they are wrong.
They're saying the vibe, just the vibes are wrong.
Yeah, they're saying what you're feeling is wrong.
Well, and they're not. I don't disagree with that. Your feelings, I guess, can be. Well,
okay.
I have mixed feelings.
Yeah.
I mean, people have thought we're in a recession and things are horrible, or people have been like, we're not adding any jobs. I'm like, no, we have been adding jobs. Like, there are some wrong opinions out there. People are thinking it might be worse than it actually is. But your point, and I think what we were both talking about is, perception can be reality too. And if you believe it to be true, your actions will be influenced by your belief system. And if you believe that the economy is in bad shape, maybe you may not make that investment. You may not buy that house. You may not do that home renovation.
The sad part, though, it's for whatever. I like to think that whatever I would prefer my feelings to be in line with what the data is. And like one of the sharpest examples of this is that 74% of respondents said that inflation has moved in the wrong direction this past year. This is a Wall Street Journal article on.
Well, they are wrong.
The respondents were taken from swing states, so Arizona, Georgia, Michigan, North Carolina, Nevada, Pennsylvania, and Wisconsin, and all of these. A whole 74% of them said that inflation has gotten worse when it's wrong. And I really love this quote here, which is starkly different from how these topics are always covered. But here's the quote. This assessment, which holds true across all 7 states, is startling, sobering, and simply not true. I'm not stating an opinion. This isn't something on which reasonable people can agree. Reasonable people can disagree. If hard economic data can count for anything, we can say unambiguously that inflation has moved in the right direction this past year. So doesn't get more forceful than that.
So here's, I guess, my pushback, and it's not I'm disagreeing with them, but it's classic example of today of we're talking about different things.
Yeah,
he's talking about rate of growth.
Yeah. And that's true.
That's not what the people that are surveyed are thinking about. And so he's like, you're wrong. And they're like, no, because they're like, I renewed my lease last week and it's more than it was last year. And I went to the grocery store and the milk is not cheaper. It's actually more expensive. So they're not, inflation hasn't, prices are higher.
Yeah.
Not everything, but prices are higher. So are they wrong? Is inflation actually better?
Yeah.
If we're talking, but what are we talking about?
Yeah.
We're talking about different things. And so if you talk about the average American person on the street, they're talking about now compared to a couple years ago.
Yeah.
Or what they're used to and familiar with, or to think for get better, prices have to come down, which that prices don't usually come down. We are, if you're an economist, you are talking about a reduction in the rate of growth. But if you treat everybody like you can't assume that everyone lives in your world of jargon and data. Yeah. And so is he technically correct? Like I get his point. Yeah. I get his point. I get it. That's like, you guys aren't seeing the improvements and things are getting better, but that doesn't make up for the higher prices that everyone is already paying, and they know they're paying. And then you're turning around and telling them they're wrong, and no two reasonable people can argue and discuss about this. It's like, well, that's like the end of being end of the reasonable discussion right there, is we can't even talk about this because I've got the data and my data is so correct, where he's missing the nuance of the actual conversation.
No, I understand that. And I appreciated this article because that was a lot of the previous coverage we had about this whatever vibe session, it wasn't necessarily a confrontation. Like this was like almost refreshingly confrontational. Everyone. So here's an example. This is this idea that people are feeling worse in the economy than the actual economy is. Has been true for the past few years. So, and the way that it's typically covered is on one side you'll have people being like, "Well, yeah, most people think that the economy is doing bad," and like, yeah, so they'll just present that as evidence of a poor economy, and maybe they'll say like, well, that's evidence that everything's going wrong and we need to vote for this guy or whatever.
People were saying the economy was bad in 2018, 2017 when things were just like crushing it. Everyone's always going to say something's bad. There's always something negative to look at, and there's always some data point of where things are too expensive and we're teetering on the edge.
But even on the other side, so let's say the cheerleaders, at least in this case, are largely, instead of these like the Wall Street Journal would say, you're wrong. And you get this kind of hand wringing, like, well, yes, I know. Like, what are we going to do about this mismatch between feelings and reality? And, a lot of people are worse off, and there's a lot of the economy that isn't fully captured by these numbers. So, their feelings, they don't make sense to us, but like, we got to respect them. And, sometimes the feelings are not that accurate. And that's all I'm trying to say is, and don't be afraid to say if they are.
I know you're right. The feelings aren't accurate, but the feelings can still be important.
That's true, and you
should know that.
Yeah, that's true.
As a father, they certainly can be wrong, and it doesn't mean that they don't have to be addressed and can affect everybody.
Yeah, that's true.
Right.
It's as a kind of like just one last accompaniment. This new jobs data did come out showing 303,000 jobs added, which is good numbers, which is a counter to maybe another good thing that would prove these vibes wrong, I guess. The peak from June 2010 to February 2020, which is like my pandemic period, where I'm going
to take the pandemic anomaly out so we can see some real graphs.
Yeah. So you can tell that recently the job growth numbers have been, on average decreasing from upwards of 1 million jobs added. It's like 900,000 jobs added in July of 2021 to now we have 301. That looks bad, doesn't it? Well, if you take the pre-pandemic numbers, this period between June 2010 and February 2020, which is a nice, kind of calmer period, I guess, not volatile. The peak was 387,000 jobs added, and the average was about 185,000 jobs added. So the jobs numbers that we're having right now are, on the whole, historically pretty good. And the fact that we have had, improving jobs numbers the previous month, improving job numbers this month, and it hasn't ticked down like sometimes it does, and you can see that right here.
So you're in the camp that, and I say this, it's a little bit of a joke, but you're in the camp of higher job numbers is a good thing.
Well, I know. It's hard. Well, it depends on what war I'm waging, I guess.
It's bad news for people who love good news, good news for people who love bad news, which, by the way, I think 20th anniversary of that album just came out. Yeah. 20th anniversary. Anyway, if you're not a Modest Mouse fan, that's okay. But seriously, Matt, because when the higher the jobs number, again, dual mandate, low unemployment, stable prices. Unemployment's already low. Now the concern is stable pricing. Higher employment rate, more people, more economic activity, potential for more inflation, maybe. So, if you're looking at this from an inflation watch standpoint, and so the Fed is going to look at this of whether they're going to lower interest rates or not. And they're saying, look, well, certainly our interest rates aren't killing jobs. Not only are we still positive, we're still adding jobs. The rate is actually increasing because you're right. And again, there's some seasonality that plays into this, but then back in 2021, I mean, obviously this is a good trend downward.
Yeah.
The lower highs and lower lows every single time. But then, starting at the beginning of this year, I mean, you can go back to January 2023. This is when everyone was like, "Oh yeah, things are we're in the pocket. Things are good. We're in the sweet spot." Oh, I need to share this. Sorry, everybody. We're in the sweet spot. We're in the pocket. Down here in December of 2022. So I guess here's an example right here. This is why it's seasonal.
Yeah.
So now. Where were we? So this is January 2022. Okay. I mean, it's popped up. I mean, this just like it did March 2023. It goes down. I don't know.
There's a lot of volatility. What it looks like right now, we're still in that ripple effect of losing a bunch of jobs in 2020 and then gaining a bunch of jobs and losing and gaining and losing and gaining. We're approaching what I think is a little bit of normal. And that's what I'm excited about, is maybe it will become less volatile.
Yeah, I think if we just stay around here, and again, this isn't a bad thing, as long as inflation doesn't keep, a wage price spiral is not like a guarantee.
Yeah, it does.
But that's what you have to watch out for.
Yeah.
Because as people are getting jobs, employment jobs are tight. Man, I was going down to a restaurant in Evansville because we're buying a deal down there, and I was going down, check on things, do a tour with some folks this week, and I called down to make a reservation.
Yep.
After they opened, and I was like, hey, I'd like to make a reservation. They're like, oh, we're not sure if we're gonna be open.
Oh.
And I'm like, what do you mean? They're like, well, we don't, some people didn't show up. We don't know if enough people are gonna show up, to work today. So we don't even know if we're gonna be able to be open for dinner tonight. And so, finding, employees is still a big challenge. It's still a tight, labor market out there, which, if you can't find somebody, if you want to stay open, you might have to pay a little bit more. Means you might have to raise your prices at the restaurant or wherever it might be.
Yeah. That's crazy. And I don't know of a
like,
good
we
way
don't know.
Yeah.
I'm like, I'm like, you don't know if you're gonna be open tonight? He's like, we don't know. Call back at 4.
Oh man, I was about to praise them for their honesty. Instead, they seem a little bit brusque.
He's like, I'm in the middle of it, man.
Yeah.
I'm trying to figure out. I don't know what to tell you. I'd be happy to serve you some dinner. They ended up being open. We got a reservation.
All right.
So thank you to the Cork and Cleaver.
All right.
Down in Evansville, Indiana. Good prime rib and salad bar.
Solid.
Hadn't been to a salad bar in a while.
Yeah.
COVID ended a lot of salad bars.
Hey, you know
man.
what salad bar is? Self-service. You don't have to pay someone to bring that plate over to you. You're getting yourself.
We still tipped.
Oh, good. No. Tipped with prime rib.
No, we had the opportunity to go make our own salad, and
exactly.
the plates were ice cold. They had
great.
They had that figured out. Anyway, as we digress, Matt, we talk about this all the time on the show. So when this report from CBRE came out, I was like, this obviously we got to talk about it because the Midwest is a region that often gets overlooked for a variety of, fine reasons. It's, we don't have a ton of mountains or the ocean or New York or Los Angeles or high taxes.
Yep.
But there are some incredible things going on in the Midwest. People are surprised, like, oh, people live there. It's a great place to live. It's tax friendly, usually business friendly. Great place to raise a family. And there's actually a lot of good growth, population growth, job growth. And this whole idea after the pandemic of like, we got to reshore, we have to build some things in the United States of America. Where are we going to do it? Well, where are the right to work states? There's Indiana. Where do we have a population that, can work in manufacturing? It's the Midwest. Where is a low, relatively affordable cost of living, as well as, wages that are lower than some of these West Coast or East Coast, coastal, wherever high price markets? It's the Midwest. Where are we going to build all our semiconductors? Where are we going to build the EVs and the batteries? And everything that was going in China, we were like, we need to maybe build that here. Maybe not in China, but also here in the United States. It's the Midwest. And so they were going through a major manufacturing boom that we're just in the first, half of the first inning right now, that is not only driving job growth, it's driving population growth, not only the cities, but the suburbs.
Directly relevant to multifamily, for sure.
Oh, yeah, for sure. And on that, it's also the region that is seeing some of the most rent growth because of the stability on the supply side.
Yeah.
There's moderate supply. There's some markets that it's above average, but it's very balanced relative to the rest of the country, especially compared to the Sun Belt. So that's why the Midwest and the Northeast, but especially the Midwest, is experiencing overall very positive rent growth, really positive apartment fundamentals. And so, I've even heard some people suggest that, the Midwest is like cities like Columbus, Ohio, Indianapolis, Kansas City, could be set up for potential. I don't even like to use the word boom towns, because then that would kind of goes counter to the reason why the Midwest is great, but poised for, a decade or more of strong, stable, and healthy growth. And you can still get in multifamily assets at a really strong and attractive basis. So that's just me.
No,
That's just me bragging about the Midwest.
Yeah.
CBRE, because that's what I say that stuff every week or whatever. CBRE is like, great report. Not only are you guys right, hitting the nail on the head, here's a research report to back that up.
Yeah, and I'm glad that that all of that really resonates with the way I was thinking about this report and this idea of inshoring and maybe even just industrial development in general is like, what if you're looking at a market, and we've done this in a lot of the materials that we market to our accredited investors, we give them articles that are like, hey, this is the plans for a factory that's being built here. Hey, here's another manufacturing plant that's being built here.
Yeah.
These are big headlines, and in a way that is a little more forward looking than looking at population growth trends in general. Because if you know of a huge billions of dollars of chip manufacturing plant that's going on in the suburbs, that that's not yet recorded in the population growth yet.
No, job growth is definitely and like job openings in markets and new job openings is definitely a leading indicator for population growth, as people will travel and gravitate towards where good jobs are. And if you get a good place to live, good economic situation.
Yeah, and ultimately
basketball.
Exactly. Well, and what CBRE says, the reason why all these people are coming to the Midwest, at least partly, is because of, quote, it's ample land available for development and a reliable workforce. Those two things, land and workforce are really great. I think that there's other aspects. And what I wanted to, what I was thinking about too, is what does the government, what kind of policies are in line? What does the geography look like? Like you said, flat land, something that's developable, and what kind of industries are we going to be catering to?
We've got the workforce, and again, like many states, not all, like not Michigan, but like Indiana is like a right to work state. And so again, we have a population that has already been involved in manufacturing, that can be hired, ready to go for manufacturing. We have the land, we have the water.
Yep,
that's a big thing.
Oh yeah,
we've got plenty of water, and we've got the capacity.
Yeah,
and so and many Midwestern states are the same way, just like Ohio, Illinois, except they don't have as good a political situation or tax situation.
But I think that water, it could be an incredibly relevant resource going forward. You need all that coolant for whatever your AI data centers are working on, and that could any kind of geography that if it's in your favor, it seems like there are very ample reasons, regardless of whatever it is, that people are moving into the Midwest. I think some of it too is a little bit of location, centrally located. True. If you're talking about reshoring and you're not trying to ship it to the other side of the world, then you can go where the population center is.
And this is true for not just Indianapolis, but Indianapolis is our home base, so that's what I know the most of. But Indianapolis, it's the busiest cargo airport in the country, and the second largest FedEx hub in the world besides Memphis. But both Indianapolis and Memphis are very logistically very key locations. Indianapolis is on the crossroads of America, more major interstates pass through Indianapolis than any other major city. But to Indianapolis, you can ship within a half day's time, 12 hours, to over 85% of the entire United States population.
That's the kind of things I was thinking of. It's like, when these people are deciding where to build their factories, are they going to build somewhere that's in a corner tucked away where the land's really cheap, or maybe they'll build somewhere where you can access half the country.
How do we get
easily.
it? Because time is money. Logistics are really important. Remember when the baby food, the baby formula crisis happened, and we didn't have enough baby formula. When they shipped that in from the Netherlands, I think they shipped it in Indianapolis, and it wasn't. They New York. They flew over New York. They flew over Boston. They flew over Philadelphia. They didn't go to Chicago. They flew to Indianapolis because of the logistical advantages.
Interesting.
And they had the company, I'm blanking on the manufacturer. So they had a fulfillment. They also had a facility in Indianapolis because of the logistical advantages. And so again, not just picking out Indianapolis, a lot of these other Midwestern markets have a lot of similar advantages or unique competitive advantages that again have largely been ignored from investors, and especially in the multifamily space, because the attention has been taken up by the Sun Belt.
Yeah.
Either the Sun Belt or, your own niche, local kind of coastal city. If you're a New York investor, maybe you're or a coastal investor, you're investing in DC or Boston, or New York. If you're in California, you're investing in the California markets because you like California. And again, the Midwest is flyover country to many people. They're not even sure what's going on. Who lives there? What do we do? They think it could be wiped off the face of the earth, and they wouldn't notice anything. I mean, I lived in New York. I've heard it all. I lived in New York for a minute, and where is that? Do you have internet? And what farm are you from?
I was looking at some of the articles about like the vibe session and stuff, and there was a Financial Times article, on that topic, and someone was like, "Oh yeah, manufacturing isn't doing great, especially in the Midwest, where they're just forgetting about these Rust Belt states and all of these
Rust Belt. Everyone, it's like, and there are some rusty old towns. There are Rust Belt cities that only had one factory or two factories, or
they're not quite as forgotten as people may assume.
No, but there are still the Gary, Indianas that exist, or the Toledo, Ohio. I don't want to offend anybody, but like there are there are cities that like still like are struggling. And they don't have necessarily a great trajectory, but there's cities like that across the country also. But that's not the majority of Midwestern markets. But that perception has really influenced folks, and so they're like, in the Midwest, like it's not sexy.
Yeah.
And so, but Atlanta, hot Atlanta, Florida, Texas. Now we're talking. They've got sex appeal, and what people pay up a stupid amount of money for sex appeal. And that's what they've done. And that's why people are getting foreclosed upon. Even though everyone's a smart, conservative, sophisticated investor or whatever, they went after the sexy, high population growth numbers. And that's the only thing they looked at. And they're like, the migration trends. We're we're looking at migration. We're looking in the smile states. We're looking in the Sun Belt because that's where I vacation to, and warmth is good.
Yeah.
All is true. But you can be right about the trajectory of something, but you can pay too high a price for it. And that's exactly what's happened.
Whether it's for investment properties and for really just cost of living period, where the rents are high over there too, and that is a cost of living.
I know people
really
who
relevant.
have moved from the Sun Belt back to the Midwest because they're like, I can't afford it. I mean, talk about insurance, property taxes. In Texas and Florida. Don't get me started. I mean, we've reported how the multiples that insurance has gone up in those markets because of hurricanes, et cetera. Yeah. Property taxes in Texas are absolutely, horrible. So are there great markets that have a ton of growth? Hell yeah. But, and
that's that is a theme.
It was a little. It's like, some of it's a little lazy. Like, are there super smart investors that have done amazing deals all through? Of course. But I think there's people who are a little lazy.
And it is a shame too, because I think that's interesting. The idea that we're uncovering, or not really uncovering because we knew it the whole time, the idea that there are these markets that are actually pretty vibrant that most people don't. I like having that knowledge. That's nice.
Oh man, I remember I was at a conference. This was pre-pandemic. I remember talking to this guy, and so funny because their whole thing. I told him, we were in the Midwest, and this is a conference. It was in Napa Valley, California. California. And I was telling this guy about our whole thesis in the Midwest and how my belief. Again, this is 2018, 2019. I'm like, well, there's a lot of inefficiency in the market, and we're doing this basically kind of geographic arbitrage. If we're taking really attractive debt that you're putting on these deals, you're paying a 5 cap for, and we're buying 6.5 caps in the Midwest, in markets that are growing faster than the markets you're investing in. And there's we think there's going to be some appreciation and stability and all of these reasons. And I remember him saying, he's like, we actually have the exact opposite thesis. We think that everyone's going to leave the Midwest because there's nothing to do there, and everyone's going to come to California because it's a great place to live. And everyone's going to live around Silicon Valley. And in the Bay Area.
Well, we all have that money, I guess.
How out of touch? And it's like, are people going to want to always live in California because it's an absolutely beautiful place? Like, for sure. It's really expensive. The taxes are really
You know
high.
what?
The
And
homeless
here's the
are
thing,
everywhere.
too.
You can't have a gun.
Every city, and I'm probably going to get this wrong because there's probably, some really ugly cities, but I'm sure there's a really nice park in each and every city in America. There's probably, you can drive to a pretty nice area and go for a little hike if you want to. But not every
It's the
place
same
needs
thing.
to be on the edge of a wonderful, pristine lake or ocean shore.
I'm envisioning you taking somebody to a park in Gary, Indiana,
No,
Matt.
I'm thinking of...
I'm envisioning you taking this guy from the coastal California to a park in April in Gary, Indiana, and be like, see, you could take a walk.
Yeah.
What else? You just want to get some fresh air and exercise. What more do you really want?
It's an amenity,
which there is a little bit to that. They did push back a little bit, but I think we all get our point.
Yeah,
is that obviously there's a lot of points. One, we all have home country bias where we think we're from is really great. And that's one of the reasons, honestly, man, I took the Midwest for granted for many years in Indianapolis. And I even looked earlier on in my kind of investing career, I looked elsewhere. I mean, I was looking at Indy because I knew it, but I was also looking at going to the Sun Belt as well. Going to the Carolinas, going to Atlanta, going to Tennessee, going to Florida. Never really looked at Texas that much just because it was far away and a lot of people already in Texas. But I kept coming back to Indy and I was like, this is an incredible market. I'm looking at these other properties and the returns don't look. I can come back to Indianapolis, a market I know how it's growing, and I can make more money, and I can be closer to it. But I'm getting a better deal. That's why real estate's great. It's an inefficient market. It's like everyone's taking this idea over here, but I can have this insider knowledge. It's not even insider. I just know it to be true and take advantage of it. And there's still opportunities to do that in the Midwest today.
And speaking of opportunities, if I want to segue back into the CBRE article or report, really is they do give examples of when I said billions of dollars of development are happening, and just for one is. It's happening in a big way in Ohio, and I'll just use that as a clear leader. They have
in all of these, they're just like picking up some of the most well known. There's just like
true.
I know there's so many other projects in all of these states, and there's things that have been announced. So this is just scratching the surface.
Exactly, and just like a few examples. So there's there on the lower end, I guess, is this $55 million Milwaukee tool plant in Wisconsin that could bring 150 jobs. On the other side is a huge $20 billion, 3,000 jobs adding Intel mega site in Ohio, just outside Columbus. And then maybe there's some places in the middle, which is still sizable $3.7 billion Eli Lilly project, adding about 900 jobs in Indiana. You can see examples throughout this report, but they also have statistics that I think that are also fairly compelling. May not be as forward-looking, but definitely shows the progress of whatever reshoring has looked like from 2020 to 2023. They look at manufacturing GDP growth, manufacturing employment growth, and then the average weekly wage growth for manufacturing workers. And the leader here, a clear leader, is Michigan, which is the top for GDP growth at 21.3%. Far and away the best here. And for manufacturing job growth at 9.4. Indiana actually leads for manufacturing wage growth at 16.3. But again, all of these have positive growth for their numbers here. All of them have strong prospects when it comes to the industrial sector. And really, and I was talking about what industries in industrial. It looks like they're really targeting these places that build things. We want things that are made in here. And if we're talking about reshoring, objects getting sent from one place to another, it makes sense to send them or it makes sense to create them in a place where it's easy to ship them out, like we said before.
Exactly. They got the workforces, we got the logistics. It makes a lot of sense. So I think the Midwest is. I mean, these are not flash in the pan projects. These are multi-decade projects that they're going to be built and they're going to be operating for a long time. And then there's all the ancillary businesses and jobs that get created around all of these also.
And that's what I was thinking too. And I've mentioned this before when we were talking about SimCity, how you've got to have the industrial sector, the commercial sector, and the residential sector. You can survive with jobs. It almost seems like there's like a seed. In the industrial sector, you're creating something from nothing almost, or
But you can have the industrial growth without all the residential, and then the residential. You can have a little bit of residential too. You need each other, but you need to have the jobs, and industrial pushes the needle.
And then there's the commercial sector that kind of feeds off those other two.
Yeah,
where it's it's like you're selling the pickaxes to the to the miners, or you're feeding them dinner or whatever. But it does seem like there is an importance. I'd hesitate to say primacy because I don't know enough about sociology or city development or anything like that. But it seems like a primacy in the economy when it comes to these manufacturing places that are going to produce these things and really create wealth for a lot of people that could be spent within that community.
Yeah, I agree. Well, Matt, I mean, we could talk about the Midwest and how great it is all day long, but let's hop into this apartment list report to get some of the latest data on the national multifamily market, but also getting into some specific metros. We cover the apartment list report because it's a really good one pretty frequently. Looking at United States median rent 2017 to present, we're oscillating back and forth, nice little sine waves kind of trend to the negative, but we are seeing some seasonality, some seasonal lift, which is great. But obviously, as we mentioned previously, this is all on top of quite a bit of growth that was experienced in 2020, 21 and 2022 till things started really cooling down in this latter half of 2022 as that supply started hitting the market.
Yeah. So rent growth is year over year. It's negative 0.8%. It is worth noting that Apartment List typically measures slightly lower rent growth than other rent growth data from places like CoStar or Yardi Matrix. But there is strong monthly rent growth numbers, which are at a positive 0.6%. Yeah. And that also follows a consistent trend of recovery. That is both this is the typical seasonal rent growth that you would have, in like a pre-pandemic year. And it also, the fact that we are improving after such a lackluster 2023 is worth noting as well. And as you can see here on this chart, it shows how much monthly declines there was in 2023 and how much monthly declines there was in 2022. And it looks like 2023 was a little bit weaker. Like the real bottom point of the apartment rent growth for apartment rent growth was actually November 2022. That was really where the heaviest losses were, I guess. And then it got it tried
last year. But I mean, that was a seasonality of okay, we would come off some declines, let's try to push a little bit, but never really was able to get that real momentum and punch above. Typically, we see kind of that peak, usually more of like in the July, but really kind of it peaked in March and then never really even exceeded. We had the strongest rent growth in March, but again, typically it's usually in June, July time periods where we see a ton of growth. And so this is a really good sign because this is really looking a little bit more like 2019 maybe, which was a pretty decent year. Wasn't the best year, certainly wasn't the worst year. And what we said last month is, February, decent sign, in positive territory. That's good, but we would expect that, but we need more data. Well, we've got one more piece of data and we still need more data. But so far it's another piece of very positive data for multifamily performance. And multifamily needs it because again, interest rates are up, costs are up, insurance, you name it, expenses are up. So we need that revenue top line item to grow as well. And so this is welcome news for multifamily owners.
Yeah, just to kind of compare. So what we're looking at is this transition from winter 2020, fall 2022 to 2023 versus 2023 to 2024. Okay, so last year around this time, we were coming off of the biggest drop in rents ever. This year, we're coming off of the second biggest. So you would think that the trend is, all right, so this bump up is going to be a little bit more than the bump up that we saw last year. My thought is if technical analysis is worth anything here, the pattern should be that next month we have even higher rent growth when last year in the April numbers were lower than the March numbers.
Which was not usual. I mean, as we see almost every season, it's increased month after month after month until we kind of get mid late summer, and then as we get closer to school starts and we need to make sure that we're fully occupied, that it's not a reduction in rents, it's just a reduction in growth. Start slowing down, and then you get into December, January, as we talk about as You can't even evict somebody in December, and so no one's moving in December, and you want to make sure you're in school and you're in place, before school starts. But it gets cold. No one wants to go around. No one wants to look at apartments. No one wants to sign a lease. But then New Year's coming around and everything's warming up a little bit, and maybe you're going to start getting out of there and making a new decision and signing a new lease.
Yeah, and what it, I can be. I am afraid of making predictions on this show, but I will predict that next month we have stronger rent growth as measured by apartment lists than we had this month. So that you can expect that, just because it just seems like the trends are in that way. And all of this rent growth, again, we're still seeing increased elevated apartment supply. There's an open question about how many are going to be completed by the end of the year, but it's not like they're going away. And so that's what it does seem like in that case, absorption is coming up to meet a lot of this new supply.
Yeah.
And when it comes to individual markets, what kind of notable is they have this map here where you can click, and I really like to do this, where you can click and see how the map changes from year over year to month over month for each county or market that they cover in the report.
Oh, are we going to go to the this color chart?
Not the color chart. Actually, it's right below that. It is this. I think it's some Tableau software. So right now we're looking at, if you scroll up just a little bit to be able to click from one to the other above the map itself. So right now we're looking at the yearly rent change, and it shows how the Midwest is outperforming the Sun Belt. Midwest is in the reds, and the Sun Belt and Southeast mostly are in the blues. Now, if you go to the
slow down, Norwich, New London.
Yeah, exactly. The Midwest and Northeast are still the top ones, and that's been true basically for the past, I don't know, 6 months to a year. Yeah. But if you switch to the month over month view, it kind of shows the Sun Belt creeping up in terms of performance. They're not so slow anymore. They're recovering, it seems like, in a way that could hint at a overall recovery in the market.
They need it.
Yeah. And it's just fun you can click from one to the other and see that
Texas,
different
cranking.
Yeah. That Odessa and Midland, Texas were among, I remember this when everyone...
Austin's still ice cold.
Yeah. When a lot of these markets were doing really well, I remember, Midland and Odessa were not doing quite so well, but maybe it's the oil drilling or something. They're benefiting from it.
Yeah.
But yeah, I think so. We're still in the year over year. This Tableau software may not work completely, but okay. Here we go.
Sorry, I thought I was on month.
Oh, no, it's fine.
I thought I was on month.
Now you go to once we're looking at the month over month, if you scroll down, and hopefully it will, if you remember right, it looks a little bit more red is showing in the Sun Belt, which is to say there's more rent growth on a month to month level than there is on a year over year level in the Sun Belt. So my big point is, looks like perhaps a recovery in some of these markets that had been more or less battered this past year. We were hovering over Austin with a 7% rent declines. Now, where is it now when it comes to month over month? It may negative 0.3. It's not so bad.
It could be, it's month over month, but yeah, it could be worse.
Yeah,
it could be worse.
And if you annualize that, that's still a little bit less than it is. Than that 7%. So,
but a lot of Texas markets are positive, not all.
Yeah, and a lot of these Florida markets are positive month on a monthly basis versus an annual basis. I'm not, I can't really put my foot, because there's seasonal changes, and obviously things are going to be doing better. But I think it's a strong change of an improvement in the overall economy to see this regional, almost like everyone seems to be improving a little bit better over time.
Yeah,
throughout the country.
I would agree.
So yeah, I think that things are returning to normal, whether it's normal, seasonal, whatever. I think I'm pretty excited about it, and I think that's a good feeling about the economy. And I'll say I think that's the right feeling. It's not the numbers would bear me out. So that's my call.
I think it's good to be optimistic.
Yeah.
I still got to be true. Stay true to the data.
Doomsayers get all the clicks, but it's a sad life to be looking at doom all the time and predicting it. So it's I was a little bit I will admit I was a little bit pessimistic. I think in like October-ish of last year, things didn't look so great. But I keep seeing, I keep waiting for this doom to come, and it hasn't. So
It is true that the Doom does get the attention. I was looking just on my like LinkedIn posts, which ones like have performed the best, and all the ones that have done the absolute best were the ones that were like slightly more pessimistic.
yeah, and it may be in that Wall Street Journal article they say that like, well, negative headlines typically get 2.4% more clicks or something than positive ones or something like that. There's studies in it, and you don't need a study to know that people pay attention to.
Well, that's why the good YouTubers, it's like everything's crashing, and then the content is like, this is actually why it's not crashing, but you might think it is. Actually, gotcha.
I can't bring myself to do that yet.
Yet, exactly. Well, speaking of that, if you want to avoid us having to stoop to those levels, which we're not taking off the table, but give us a like, subscribe to the Gray Capital YouTube channel, and leave a comment. Tell us we want to hear your opinion. We really do. And then let's try to get through some of those comments live on the show.
Oh yeah, totally.
Next week, Matt. All right. Well, thanks again for tuning in. We'll have another Gray Report newsletter, new Gray Report episode out soon. Make sure you're signed up. Go to graycapitalllc.com/report. Get on the newsletter. Check us out if you're a credit investor. We do deals when there are good ones out there. We're just getting ready to close on one, so it's fully subscribed right now. So, but you still give us a call, get in touch, learn about the deal. It's a live deal still before we've closed. Again, we're fully subscribed. We're not raising any more capital for it. We've got all we need. Maybe someone drops out, you can pop on the wait list. Low chance of that happening. But learn more about Gray Capital and what we do. Hop on a call with us, and let's talk about multifamily. See you next time.